Hey, everybody, this is Heather Christie, and we have a LinkedIn Live that we want to share with you from our accounting firm and wealth management firm, HBK. So I'm just going to pause my screen and have you jump onto this webinar. If you have any questions at all, this is about the CARES Act and how it impacts you as business owners, as professionals. Any questions that you have, please just enter them in the comments and we will get to them. I'm hoping to do a live interview a little bit later with one of the experts from HBK. So I hope this helps.
So the last thing I'm going to say before I get into the slides here is you have to remember during all of this as well that whatever the SBA says and whatever the banks say is what goes. That is what is going to matter at the end of the day on exactly what costs qualify, how do you get forgiveness, what is the process like, and some of these finer details. Anything that we say today, although we believe that we are not interpreting any of this outside of what the law states, we cannot guarantee that this is exactly how the SBA is going to interpret it or that how the lenders are going to interpret it. So please, you have to start working with your banks on the finer details, but hopefully this gives you a great overview and a good start into that process. So very simply, let's start off with what is the Paycheck Protection Program? So it's part of the CARES Act that was signed into law last Friday, I believe it was. It allows a qualified business, which we'll talk about later, to apply for a loan with an approved SBA 7A lender. There's the potential that a portion of that loan, up to 100%, can be forgiven. Most banks that we seem to deal with our client base are approved 7A lenders. If you don't know if yours is, I would reach out and find out as soon as possible, because if you do need to go with a different financial institution, you need to start working on that as soon as possible. And again, I'm saying it there one more time, all of the information is subject to the SBA interpretation and guidance that is given to those lenders. So how do you qualify? You know, there's very little guidance on exactly what qualifies you for the loans, but the things that it says for sure is you need to be in operation on February 15th. You need to make a good faith certification that the COVID-19 crisis is hurting your economic conditions of your business, that there's some sort of decrease in revenue, problem in attaining inventory, unable to retain your employees, unable to pay your bills, something like that is happening, that is going on in the current environment, and that you were in fact paying payroll expenses and payroll taxes or making payments to independent contractors during this time period. So these are really the only factors that are required for you to qualify for the loan as the bill is written. So the types of qualified businesses have been expanded from your traditional SBA 7A loans. It is for small business concerns, as well as any business concern, 501c3, a 501c19, a tribal business concern that has fewer than 500 employees. Now, when you're looking at the 500 employee limitations, you have to look at the affiliation rules that are given by the SBA. Generally speaking, this is someone who controls multiple businesses or has a controlling interest in multiple businesses. And if you add up all of the businesses, get over 500 employees, may not be eligible for these funds, for this relief. So if you think that that is something that could potentially be an issue to you, you need to reach out on a more specific inquiry, and we can work through that with you. It's also noted that there's applicable size standard limitations that have been provided by the SBA. What that means is in certain industries, you can go above the 500-person threshold. That is a published document that has been out there. We're not aware of any updates to that document that have resulted from this legislation, but I will tell you that this is not a small increase if you're in the right industry. I would absolutely check that out if you're over 500. Some of the size limitations can go as high as 750 or 1,000 employees. So it is absolutely worth exploring, even if you're over 500, to rule yourself out of the eligibility of this program. It also includes individuals who are sole proprietors or independent contractors and an eligible self-employed individual. So if you have an NAICS code beginning with 72, which I believe is the accommodation and food service industries, and you have not more than 500 employees per physical location, but over 500 in total, the affiliation rules are waived. Also, if you're a business that is operating as a franchise that's assigned a franchise identifier code by the SBA, you're also eligible for this, as well as if you receive funding through the Small Business Investment Company. When you're looking at these franchise rules and these affiliation rules, again, you should be working with your professional advisors on determining that you're not eligible as opposed to just assuming that you're not eligible. So let's talk about the maximum loan amount. We're going to define what some of these items mean, but I wanted to get some framework in your minds of exactly how this is going to work before we break into some of those finer details. So the maximum loan amount is going to be the lesser of your average monthly payroll cost incurred in the 1-year period prior to the loan date. I'm going to skip those 2 small points real quick. So it's going to be that average monthly payroll cost incurred in the 1 year prior to the loan date multiplied by 2.5 times, plus the outstanding amount of an EIDL loan taken out after those dates prescribed there, and it cannot exceed $10 million in total, okay? So for the small percentage of people that have taken out one of these EIDL loans, again, a more specific look on how the interaction between that loan and these Paycheck Protection Program loans work. This should be something you should be looking at and discussing. But generally speaking, it's your average monthly payroll cost incurred over the 1-year date prior to the loan date multiplied by 2.5. If you're a seasonal employer, and as you can see there, we are breaking out that you have to be a seasonal employer determined by the SBA. You can't just say you're seasonal. It would be your average monthly payroll cost for the 12-week period beginning either 2/15/19 or 3/1/19 at the election of the borrower. And then if you're a new employer and didn't have payroll last year, you'd be looking at 1/1/20 to 2/29/20 as the period that you're using to determine your average monthly payroll cost. And then the rest of the formula would be exactly the same. You would take that average monthly amount, multiply it by 2.5 times, and subject it to the further limitations. So the big question here is what is defined as payroll cost? Because as you saw there, the maximum loan amount is defined completely off of payroll. So the payroll cost includes salary, wages, commissions, other similar compensation, including cash tips. It's also vacation leave, FMLA, sick leave, payments for dismissal or separation, retirement benefits that you're paying, group health care benefits, including the insurance premiums, state and local taxes that are assessed on the comp of employees, so think state payroll taxes. And then this last point is very important as well, and a little bit an interpretation item, which I'll mention, is the sum of payments to a sole proprietor or independent contractor that is in an amount not more than $100,000 in 1 year prorated over the covered period. So the reason I say that this is an item for potential interpretation is because exactly what subcontractor payments it includes and maybe doesn't include has not been defined. This is exactly how it's written in the law. It's saying that some of the payments to the sole proprietor or independent contractor are certain sole proprietors or independent contractors that you may be making payments to excluded, potentially. When the SBA provides final regulations and guidance to the lenders, we'll have a much better handle on this. But currently, I would be evaluating this as the potential that all of your subcontractor expenses could potentially be included in determining your loan amount. So what is not included in payroll costs? So very easily, any compensation of an individual employee in excess of $100,000 prorated for the covered period is not included. If you pay someone $150,000 in compensation, only the first $100,000 is used in the calculation of the maximum loan amount. So you'll have to decrease those level of compensated employees down to the 100,000 level in order to come up with this calculation. Also, federal payroll taxes are not included. If you're paying an employee who lives outside of the United States, that's not included. And then if you have some of the previous stimulus that was provided, or some of the previous relief that was provided under sections 701 and 703 of the FFCRA, if you're paying any qualified sick or family leave wages that you can get a credit under those provisions, you can't use those same wages and consider them payroll costs for this purpose as well. Those would need to be backed out. And it is written that anything allowed under those programs is not allowed to be included as payroll costs, which leads us to currently interpret it as you have to use those programs if you qualify under those programs, and you cannot qualify those under this program if that is the case. Again, if you're in that situation, please reach out. Please, use your lender to help you determine that. But you don't just assume what can and should not be included at this point in time. Once you receive the funds, you could use those funds to pay for payroll costs. You could use those funds to pay for a continuation of group healthcare benefits. You could use them to pay for employee wages. Now, that is already included in payroll costs. I understand that. The law specifically broke it out as a separate item, so we thought that it was appropriate to do that here as well, in case you're wondering why it seems to duplicate that. It could be used to pay interest on a mortgage that was incurred prior to the covered period. This can't be on a new mortgage that was just, come into agreement or something like that. This is used to pay rent, including rent under a lease agreement. It's used to pay interest on other debt obligations that incurred prior to the covered period. And it can be used to pay utilities like electric, gas, water, transportation, telephone, internet. Transportation is not a defined term either. As far as what that exactly means in the confines of how it gets passed down is yet to be seen. But this is exactly as it is written in the Senate bill as it was released. So the last big question that I'm going to cover prior to moving on to Amy and then ultimately into our Q&A session is, how do you apply? You do not apply for these loans through the SBA. These are applied through with your 7A lender. So again, that is most likely the financial institution you're working for. And if it's not, you need to be working to get exposure to a 7A lender immediately. And you need to begin gathering documentation. We're getting a little bit of different views from banks on how they're interpreting what the documentation is. But generally speaking, this has been stuff like, 941, historical profit and loss statements of the company, W-2s from last year, maybe your W-3, 1099 to show subcontractor expenses, payroll reports from the last payroll period, walking back 12 months from where it's at today, details of your group healthcare expenses, details of your retirement plan expenses, exactly what type of information they're going to be requesting and requiring, and exactly what type of information you're going to have to provide is yet to be seen. However, those are the type of information that goes into the calculation and will likely be the types of things that you need to gather. So at this point, I'm going to turn it over to Amy, who's going to talk about, after you get the money, how does that money get forgiven from the loan, and what happens if it doesn't get forgiven?
Thanks so much, Frank. Good morning, everyone. On behalf of the HBK family, we hope you are all staying safe and well. As Frank mentioned throughout his presentation, one of the important takeaways is that the SBA is still releasing guidance on the loan itself. The same is in effect for this portion as well, the forgiveness portion of this program. And it may take even a little bit longer for the banks to get the guidance on the forgiveness portion, since it obviously comes after the loan. So we will go through here what the law says. Just like Frank went through the original loan, we'll kind of take the same approach for the forgiveness, and also talk about a few items, other items before we get into the EIDL changes. So let's talk about what can be forgiven. Ultimately, your 7A lender is going to calculate and confirm forgiveness, but there are a few things here that we do know that are provided for in Section 1106 of the CARES Act. One important point on this to note is that the forgiveness cannot exceed the loan principal. Forgiveness may apply to the amount spent on certain costs within the 8-week period following origination. So again, that's the 8-week period following the loan origination. That's what the Act is calling the covered period. So the calculated forgiveness amount includes payroll costs, and that's the same as the cost that Frank defined earlier. You may remember him going through 2 slides, one where he presented what payroll costs include and one where he presented what payroll costs do not include. Those same exact slides and definitions pertain here to what payroll is. In addition, interest payments on any mortgage incurred prior to February 15th, 2020, rent on any lease in force prior to February 15th of this year, and payments on utilities, which again are defined as electricity, gas, water, transportation, telephone, or internet. And those services must have began before February 15th of this year. Again, as Frank mentioned, we're not sure what transportation is exactly yet. The SBA has not provided guidance on that definition. There are three potential reductions to forgiveness that you should be aware of, and we're going to go through each one of those. First, the thing that you have to remember is that the intention of the Paycheck Protection Program is to keep workers employed. Therefore, if you reduce your number of average employees, that can reduce the amount of the loan that's forgiven. Specifically, if the number of average monthly FTEs, or full-time equivalents, was reduced in the covered period, and again, that covered period is 8 weeks following the loan origination date, compared to the average monthly employees between February 15th of 19 and June 30th of 19, or January 1st of 2020 and February 29th of 2020, this can result in a reduction. Note that for most employers, they can choose which of those time periods they want to use for employee headcount comparison purposes. So they can choose if they want to use that February to June 2019 or that January to February of 2020. However, for those companies that are considered seasonal employers by the SBA, you will use the February 15th, 2019 to June 30th, 2019 period as your comparison period. Again, as Frank mentioned, that seasonal employer has to be defined by the SBA. You can't just say that you are a seasonal employer. The second potential reduction to the forgiveness is due to reducing employee wage rates. If an employee's rate was decreased during the covered period, and again, that period is 8 weeks following the origination date of the loan, by greater than 25% compared to the most recent full quarter of which the employee was employed prior to the covered period, the amount of forgiveness will be reduced. Again, I want to reiterate what that comparison period is because it's a little different. It's the most recent full quarter of which the employee was employed prior to the covered period. Note, though, that if you have employees that are earning over $100,000, they are excluded from this calculation. So you're only considering employee rates for those making under $100,000. The third potential reduction to the forgiveness is due to an economic injury disaster loan. Many of you may have participated in our webinar or others talking about these, and we'll give you some updates on the EIDLs at the end of this presentation as well. But if you applied for an EIDL and you were awarded an emergency advance, which is up to $10,000, that's going to reduce the amount of loan forgiveness you will receive through the Paycheck Protection Program based on how much of that emergency advance you actually received. Note that in any case, that $10,000 or up to $10,000 emergency advance that you receive does not need to be repaid. And that doesn't matter if you have the Paycheck Protection Program in effect or not. That amount does not need to be repaid either way. To encourage employers to rehire employees who have been laid off due to the COVID-19 crisis, note that reductions in employment or wages occurring between February 15th, 2020 and ending 30 days after the enactment of the CARES Act shall not reduce the amount of loan forgiveness if the borrower eliminates that reduction by June 30th. So just to clarify when that 30 days applies, the CARES Act was enacted on Friday, March 27th. So that's why that April 26th date is listed. That is 30 days after the enactment. In summary, this means that forgiveness is calculated by looking at eligible payroll, interest, rent, and utility payments, and adjusting if you reduced headcount or reduced employee wages during the covered period or had an emergency advance on the EIDL. Again, that's coming specifically from Section 1106 of the CARES Act. All of this is still subject to the lenders and the SBA interpretation and their work together. So some of you, I'm sure, have some questions about very specific scenarios, and as Frank mentioned, we will do some Q&A as well. But please note, it's still all subject to that SBA and 7A lender interpretation. So let's talk about a few more important notes about the forgiveness. First, again, your 7A lender is going to approve that forgiveness. You're going to provide them documentation, which we'll discuss here in a second, and apply for the forgiveness in a separate process than the application of the loan. Again, if you have questions, talk to your 7A lender. Some of the guidance has not yet been released, but obviously will be coming. Second, forgiveness is not taxable at the federal level. So that's a very important piece of this to note as well. Again, the exact process isn't known quite yet, but we do know about that backup information. And some of the items that we believe you'll need to have ready, according to the law, include verification of employee counts and rates, payroll reports, payroll tax filings, canceled checks or receipts for interest, lease, and utility payments. Anything documenting, showing proof of those payments are things that you're going to want to keep handy and be prepared to give to the 7A lender as backup for the forgiveness portion. If your loan is not completely forgiven, a loan will result with a 10-year maximum amortization period and an interest rate not to exceed 4%. You will also have the option to defer payments for at least 6 months, but no longer than a year. Your 7A lender will work with you on the exact parameters of your specific loan. So the last item we'd like to talk about is the updates to the SBA Economic Injury Disaster Loan Program, or EIDL. So very quickly, I just want to go over this program for those of you who may not be familiar with it. In short, it's a max $2 million term loan intended to support working capital needs with low interest rates and some deferral options as well. Unlike the Paycheck Protection Program, you're going to apply for this loan directly through SBA.gov/disaster. I'm sure some of you may have already been through this process. There's no fees to apply. They actually tell you on the site which information you need to provide, and an SBA loan officer gets back in touch with you to basically gather any additional information that they may need in order to approve this loan. The CARES Act, though, did make some adjustments to the EIDL program. So the first adjustment is you cannot use the Paycheck Protection Program and the Economic Injury Disaster Loan, or EIDL, for the same purposes. In fact, your 7A lender may refinance your EIDL into the Paycheck Protection Program. In any case, any company that is talking to a 7A lender about the Paycheck Protection Program and who has applied, is considering applying, or does apply for an EIDL during that process, needs to talk to their 7A lender and just make sure they're up to speed about getting both of these programs. Next, CARES allows for an emergency advance of up to $10,000 that should be awarded within 3 days of applying for that advance. We spoke about this advance a little bit earlier, but again, it does not need to be repaid even if you are not awarded an economic injury disaster loan. However, to reiterate, one of the options that reduces forgiveness is having the emergency advance. So if you receive both a Paycheck Protection Program loan and an EIDL loan, or if you refinance the EIDL loan into a Paycheck Protection Program loan, the advance awarded will be subtracted from the amount forgiven in the Paycheck Protection Program. If you previously applied for the EIDL and perhaps the emergency advance was not available to you yet, there's a couple different scenarios of what might have happened. You may have submitted your application and the advance wasn't even approved yet. The second instance is you went on the website within the last few days, sent in your EIDL application, and in big red bold letters on the top of the SBA site, it said you're going to have to come back and submit an additional application specifically for the emergency advance. If you already submitted something, you probably got an email from the SBA either last night or this morning. But in case you didn't, I want to point out that anyone who previously applied for the EIDL and not the advance, but who is interested in receiving that advance, needs to go back to the website, again, sba.gov/disaster, and reapply for the entire program. If you applied for the loan and you're not interested in the advance, you don't need to do anything differently. In their email, they said that this won't lose your place in line. They just need you to resubmit. So if you did not receive that email or if you have questions, feel free to reach out to us. We can certainly help you through that process. The last couple of items that CARES changed on the EIDLs is that there's no personal guarantee under $200,000, and they've relaxed some of the other requirements, some of the paperwork and things like that as well. So the process should be slightly easier than what it was before CARES was enacted. The last thing I want to note is that the SBA is constantly changing this online application process. You know, I already spoke about the changes just with the emergency advance. We're seeing high traffic levels, the site responding slowly, crashing periodically. They've had some maintenance outages, but follow the guidelines on the site, you know, when you are on that site applying for the loan or applying for the advance. An SBA loan officer will contact you if they need additional information. However, with that being said, make sure that you fill out all of the answers that they're requesting as well. You don't want to leave anything blank where they consider that your application is incomplete and thus discard it. Before we get to the questions and answers, I do want to mention also that we'd like to focus on questions in reference to the Paycheck Protection Program or economic injury disaster loans. If you have questions about any other matter, please feel free to contact a member of HBK. There will also be a subsequent webinar, and there's more information coming out on this week regarding the other business and individual provisions of the CARES Act. So if you have questions specific to the other provisions, Ben DiGirolamo and Amy Dallin will be able to answer those after our next webinar that's still coming later this week. So stay tuned for that information. Gabriella, I will turn it over to you.
Great. Thanks, Amy. Thanks, Frank, for all the great information. I know there are probably many questions, but we will start with the ones that we've actually received in the course of your presentation. And the first one is related to bridge loans. So the question is, if we already applied for a bridge loan, how would that affect this program? Can the bridge loan be forgiven, or should we cancel the bridge loan app?
So the bridge loan could apply to a couple of different things. You know, some of the states are actually allowing for very specific bridge loans to be applied for. And what we would recommend in those cases is that, again, if someone's applying for the Paycheck Protection Program, that they're talking to the lender about how to coordinate. Those answers may vary from state to state.
Great. Another question that we received is, can we still get payroll loans even if employees are working remotely?
Yes. So, you know, the idea here is just like it's named, is the paycheck protection, is to protect the paychecks of your employees and to be able to be, you know, stimulating the businesses to continue to do that. If your employees are working remotely, you are absolutely eligible to receive the funds and for the forgiveness factor, because they're going to be looking at what have you spent on payroll during that base period to determine your loan amount, as well as what are you spending on it and your on your workforce during that forgiveness time period as well.
Great. Another question we received is regarding 401 contributions. How are they handled in these plans or these programs?
Yeah, so part of the calculation of payroll cost is retirement expenses, retirement plan expenses. So any expenses that you have related to your employees in a 401k plan or retirement plan, I think are eligible to be included in that calculation. I would certainly assume that those are going to be included and work with your bank on making sure that everything that you're trying to include qualifies.
And just to add to that, make sure that any calculations you have do not include the employee contributions. You know, you're just focused on the employer contribution.
Thanks for clarifying that, Amy. We have gotten a couple of questions regarding what is considered payroll costs. First is, does that include leased employee costs?
Yeah, so there are specific regulations related to leased employees in the affiliation rules. If you're in a leased employee situation, I would read the SBA affiliation rules and make yourself familiar with that. Generally speaking, it breaks you from an affiliation if you're using leased employees. How it's actually being interpreted in this environment for this law is yet to be seen, but I would absolutely be working with your bank. Maybe contact us for a very specific scenario so we could help you do an evaluation on whether or not those leased employees would be included.
Great. And what about workman comp premiums? Do they qualify as insurance premiums?
Yeah, so it doesn't actually indicate what qualifies as insurance premiums or what qualifies as payroll taxes at the state level. I've heard people ask about workers' comp in both of those scenarios. Again, we're going to be looking for the final guidance on what those allowable costs are. Every calculation template that we've seen passed down from a bank or any commentary we've read just continually refers to, you know, group health insurance premiums as well as state level payroll taxes.
Okay. Are self-employment taxes considered payroll taxes?
Also a great question. So the self-employment section is a little bit skinny throughout this bill. What I read there, where it indicates that self-employed people are eligible and that they have to be capped at $100,000 of a prorated amount during the cover period, is really the extent of the guidance on the self-employment individuals. Whether or not self-employment taxes, whether or not the full amount of self-employment taxes or half of the amount or none of the amount, how that plays into all of this has yet to be given down to us as guidance. So if you are a self-employed individual that is looking to take advantage of this program, I would suggest that you work with your bank, again, work with us, work with an attorney, work with somebody to make sure that you're not leaving money on the table and wrapping in all of your eligible costs.
And just following on to that question, if income of a sole proprietor is considered payroll costs, what about income of members of an LLC? And then additionally, do owner distributions count as well?
Okay, so really quick on the owner distribution piece, there is no indication that owners' distributions are going to have any positive or negative impact on these provisions. Related to the members of an LLC, going back to the actual definition of payroll costs, it specifically says salaries, wages, commissions, and similar compensation, including cash tips. There is no specific mention of guaranteed payments to a member of a partnership. There is no specific exclusion of it. It does say similar compensation, but it also indicates salaries, wages, commissions. So, unfortunately, I feel like I'm saying this over and over for a lot of these questions, but we're going to have to rely on the final SBA guidance and working with the lender. If you're in that situation, please do not just assume you're not eligible. I would absolutely wait for that final regulations and start to work with your bank.
Great. Are 1099 contractor payments included as a covered payroll expense?
Yeah, so in the definition of the payroll cost, it says the payments to or income of a sole proprietor or independent contractor that is not an amount of 100K in the 1 year time period prorated for the covered period. So based on that definition out of the, yes, whether that means all subcontract payments or whether it means subcontractor payments for services or not for services is yet to be seen, but it is indicated in the definition of payroll costs that subcontract expenses can be.
Thank you again for participating. We hope you found this information useful, and we wish you well and look forward to speaking with you soon. Thank you.